Hello and welcome back to another episode of the Mark Moss Show, where we're always talking about the decentralized revolution, giving you the play-by-play of how this world is changing in a world of insanity, bringing context. Giving you the play-by-play so you can understand and see what's happening. Most importantly, so you know what direction we're going in. Of course, we like to look at the world through the lenses of politics, finance, and technology together. It's the technology that changed the world more than anything. And of course, that technology that's changed the world is Bitcoin and the decentralized technology, but it's changing the world of finance and the world of politics. And so when we look at the world through those lenses, it all starts to make sense. And some of the biggest news headlines that broke this week that really demonstrate where things are going couldn't be any better for what we're talking about. We're going to look at the U.S. credit rating and how it just got downgraded. We're going to talk about what the SEC, the Securities Exchange Commission, secretly told some crypto exchanges. We're going to talk about a big deal that happened in the United States, the first time we've seen it in something like a decade, and more news around the world. So let's go ahead and just jump right into that. One of the big pieces this week was the U.S. credit rating got downgraded. Now, I hate to say I told you so, but I told you so. What do I mean by that? I covered the debt ceiling debate extensively. We talked about it. I made videos on my main YouTube channel, which, by the way, if you're not following me on YouTube, you should check it out. I make videos with charts and graphs and very illustrative so you could see it and kind of understand it better. So check it out, Mark Moss on YouTube. But I covered it here on the radio, the podcast. I covered it on YouTube as well and talked about, what the fight was about, what the debate was about, the pros and cons if they do that. But what I said is that regardless if a deal got agreed on or not, it was going to cause damage. I referenced when we got this close to a debt ceiling standoff, a debate standoff in the past, and what happened after those in 2011, 2013. And I showed how after we got very close to a default, but then it got saved at the last minute, the United States credit rating got downgraded. All right, well, history doesn't repeat, it rhymes. Well, in this case, it repeated, and here we are. We had another debate go down to the last minute, and we just witnessed another downgrade. Now, this is sort of a nothing burger, but it's also something at the same time. So I didn't want to spend a whole lot of time on it, but it's important to talk about for a couple reasons. First thing is, one of the rating agencies downgraded the credit. Okay, whatever, big deal, right? I mean, it's just one agency. In this case, it was Fitch. And they moved it from AAA down to AA+. Okay, well, that really is not a big deal because the change from AAA to AA+ doesn't really change the capital requirements that the government has. In addition, everybody that's going to loan money to the government, we're talking about other nations, sovereigns, and even you, if you're buying bonds and treasuries, you're loaning money to the government, we already know the situation that's going in. So I don't think it materially changes anything. It doesn't change capital requirements, doesn't really change the interest rates. The government, the Fed's just going to print the money to buy their own bonds anyway if they have to. So it doesn't really change it from that perspective. But the reason why I think it's important for us to talk about for a minute is because of why it was downgraded. Why? Now, of course, the debt ceiling debate was part of that, but it's actually much bigger. As a matter of fact, Fitch, who downgraded it, gave us the reason why. They said tax cuts, big government spending programs, and concerns over the repeated debt ceiling political battles in recent years all undermine America's creditworthiness in the eyes of investors, especially compared to the other countries with perfect credit ratings. So, tax cuts, big government spending programs, and concerns over repeated debt ceiling battles. So let's just look at those. So I've covered this extensively. Big government spending programs. So we know that the government cannot stop spending, and not just stop spending. I'm talking like a drunken sailor. So leading up to the pandemic in 2019, well, let's just go back. Throughout history, when the governments need to spend more money, they do. So, for example, World War I, World War II, the U.S. needs a lot of money, so they take on a lot of debt. Go back hundreds of years before we even had a fiat money system. If a king wanted to go to war, he would have to borrow money from the rich guys because gold was money at the time. They couldn't just print it. And so the king would have to borrow money to go to war, right? And so same thing today. The government needs to borrow money. They issue treasuries. And so we see massive spending by the government during those times of war. But after the war is over, the spending goes back down to normal. I broke this down on a radio show a week or two ago, talking about how this government spending, this deficit spending is actually inflationary. But the reason why it's important to understand is that in this instance, we went into a war. It was the pandemic, a war against the pandemic. And leading up to it, at the end of 2019, the U.S. government's budget was about $4.8 trillion. 4.8 trillion. Then they spent a lot more to fight the war, the pandemic, send out all the stimmy, et cetera. But after the war was over, they didn't return the spending back to where it was. During the war, they increased the spending to fight the war, send out the stimmy, by about 50%, and that's where it is today. So they jumped from 4.8 to about 6.5 trillion in spending, about a 50% increase, and kept it there. And that was part of what this debate was about, was, hey, we need to bring spending back down to normal. And the Biden administration is like, no, we will never go back to normal. This is the new normal. We will not cut it. And so that's a big problem. And so here we have big government spending programs. That's the problem. The U.S. Treasury and the Congressional Budget Office put out a report in 2021 and titled The Unsustainable Path. So we know that this is not sustainable. We know that there is no way to come out of this. This ends badly. So everyone sees that. Fitch sees it. The world sees it. And that's why they downgraded it. They also cited the political battles. And they also cited a breakdown in society. It's not good. So obviously, as the money continues to lose its value, it gets harder and harder to live. You take on more and more debt. Economic growth slows down. Economic growth slows down. We have to do more social programs, which means we need more economic stimulus. We have more people that are unhappy, not making ends meet, and not working, which leads to massive amounts of societal unrest. You see it in the cities. You see it in San Francisco. You see it in Chicago. You see it in Detroit. And that's another one of these things that they cited. That is not a good sign for a nation. Now, if they've downgraded the U.S. government, things have gotten pretty bad, right? Again, like I said, it's sort of a nothing burger, but what it does is it reinforces that we know we're on the same trajectory, the direction that we're headed. Now, it's important to understand that there's actually a handful of states in the United States that have much higher ratings than the U.S. And of course, some of those would be like, Texas and Florida. Nations that I would just say, by the way, have no state income tax. They have no state income tax, and yet they run budgets, and they have much better credit. In addition to the economy, we also saw the jobs report came out. The JOLTS report showed that job openings fell to 9.58 million in June, with 1.6 per available worker. That means that each available worker, that means workers who are still actively looking for jobs, have about a job and a half to go consider. It's really low. Very, very low. That means that you don't have a lot of options, which means that employees can now bargain. They have the upper hand. There's not enough employees to go around for the jobs that are opening, which is great for the workers. It's bad for the businesses, but more importantly, not so bad for the business, it's bad for the customers. Because if the business has to pay the employee more, then they have to charge more for their goods and services. So we saw that happening really big. But we did see some changes with the banks themselves. So as I said, the credit ratings didn't really change the capital requirements, but we did see some regulators change some of the requirements in the banking requirements. So banks that have more than $100 million in assets are seeing about a 16% increase in common equity in what they call tier 1 capital requirements across the industry. So a little bit of movement on the banking side of things. But one thing that we see is that what this problem has really caused, remember, the Treasury says we're on an unsustainable path. And as the Fed has gone on this war path of raising rates at the fastest rate in history, two things have happened. One, they're trying to make you poor and broke so you don't spend as much money. But they've actually made the government broke. As a matter of fact, and then they've made the interest on the debt more expensive than it's ever before. And now, for the first time, the U.S. Treasury is spending more money just to cover the interest on the debt than they are on the military. Government spending grew by 15% last month to a total of $646 billion, with a deficit of only $228 million. Now, you don't have to get caught up in this. I've liked to participate in what I call alternative investments outside of the main industry that keep me insulated from this. And you've probably been hearing me talking about my friend Dutch Mendehall. He's the co-founder and CEO of Rad Diversified, and he's the president of the Alternative Investment Association, founder of The Rad, and he's also the author of a brand new book called Money Shackles. Money shackles are, financial things that hamstring us, that kind of hold us back. Now, he likes to talk about using debt to your advantage, how you can tap into lucrative alternative investments, and you can actually redefine and build your American dream. And he shares all of this in his brand new book called Money Shackles. You can learn more at therad.com. Again, that's THERAD.com, therad.com. Check it out, the book Money Shackles from my good friend Dutch Mendehall, the founder of Rad Diversified. Bitcoin, that's really what's changing the world. And it is changing the world faster. It's like on this accelerating pace. It's like a snowball, like getting bigger and bigger and bigger and gaining steam as it goes downhill. And we really saw it highlighted this week in this article that kind of blew me away. And you've probably heard me and many other people talk about Bitcoin, not crypto, right? You've heard that before. And what that means is, we're not saying that Bitcoin is not a cryptocurrency. Technically, it uses cryptography, right? So yes, it's a cryptocurrency. But what we're trying to say is that when we're talking about Bitcoin, we're just talking about Bitcoin. And when we talk about crypto, we're talking about everything other than Bitcoin. So that's kind of what we're talking about. And the reason why is because Bitcoin is completely different than every other, whatever, there are 25,000 cryptocurrencies. And obviously there's a ton of differences, but the main core difference that changes everything is what the SEC, Securities and Exchange Commission, came out and stated. And so you probably already know, I've been talking about it pretty extensively over the last about a year now, how the SEC was going to come out on a warpath and just regulate the heck out of cryptocurrencies. I even went as far as to say that I think that we have probably seen the last cryptocurrency bull run. When I say cryptocurrency bull run, as a broad market, sure, there will be individual assets that will pump here and there, but as a broad market, I think it's over. But I think that's actually beneficial for Bitcoin. So I think Bitcoin will pump even harder because of that. And the reason why is, as I said, right, the SEC was going to come after these cryptocurrencies so hard, and so they have. Gary Gensler, the head of the SEC, has been filing, suit after suit after suit. And really, it hinges on a claim that, again, most of these cryptocurrencies can be classified as securities or financial instruments. And, this goes back to like this Howey test, which was from 1946, and it was about an orange grove, which, of course, how does that apply to cryptocurrency? But it kind of does. And what the SEC is saying through all these claims that cryptos can be securities is they said that none of this that they're talking about applies to Bitcoin, which they said is the world's most decentralized crypto. Now, not only is the most decentralized crypto, it has the market cap of pretty much all the other cryptos combined. And the SEC said that, quote, "We believe every crypto asset other than Bitcoin is a security." That's what they told Coinbase before filing this litigation. Now, he said, Gary Gensler, the head of the SEC, said, quote, in New York Magazine, quote, "For everything other than Bitcoin, you can find a website, you can find a group of entrepreneurs, and these tokens are securities because there's a group in the middle in the public that's anticipating profits on that group." Now, it is worth noting that there was recently a ruling by the court on Ripple. So Ripple Labs and XRP, the token. And so the court came out with like this double ruling where they said, the token itself, XRP, the token, is not a security, but selling it to the institutions was a security. So how does that work? Well, the Howey test in 1946 was actually written about orange groves. So let's think about it in the orange groves. An orange is not a security. It's just an orange. But if I raise investment capital for an orange grove, and then I promise those investors when those oranges grow, I'll give them the oranges, that is the security. The orange itself is not a security. It's just an orange. But the transaction is the security. They own a secure interest in that orange grove backed up by the oranges themselves. So the oranges aren't a security, but the contract to give the investors oranges is. And so basically the judge said XRP, the token, is not a security. It's an orange. But the contract that allowed these investors to get the tokens was. And so everybody rejoiced, XRP is not a security. Of course it's not. Of course it's not. Like that didn't need to be said. Like it's an orange. But the way they sold it was. And so it's important to understand that. But, we'll continue to see how this plays out. I think it's important to see that Bitcoin itself is not a security. But there's going to be more and more legislation. As a matter of fact, we saw a lot more this week. The House Financial Services Committee approved legislation that would create a framework, a regulatory framework for the issuance and trading of digital assets at the SEC and the CFTC, which is the Commodity Futures Trading Commission. Now, I'm not a fan of any of this regulation. I wish that the SEC and the CFTC would just shut down in disgrace and go away. I don't think I need any regulatory body to protect me and what I put my money into. If I want to buy lottery tickets or if I want to go to Vegas and put it on 27 Red, then I should be allowed to do it. It's my money. I don't need them telling me what I can. But here we are. Now, they're talking about this bill that is basically trying to, like I said, create this framework where they want to have like this certification system that shows that a blockchain is sufficiently decentralized. Now, what I really hate about this is who's to say what that even is. Now, I personally, I guess I'm a decentralized maxi. I don't think there's such thing as decentralized-ish. It either is or it isn't. In my opinion, what determines it is, well, I think Gary Gensler said it, right? They have websites. They have groups of people that manage it. Bitcoin has no website. There's no group of people. But more importantly, it's because instead of one database, there's many. In order to have many, everybody in the world must be able to run a database. And that, to me, is this big distinction there. And so they want to create this regulatory framework to see if it's sufficiently decentralized. Okay, whatever that is, it's arbitrary. There's another bill that opened up, led by... Elizabeth Warren. I always laugh when I think about her because I want to say it, but I don't. But I'm just going to say it. I always laughed when Donald Trump would call her Pocahontas. If you don't know what that means, she ran forever on a lie that she was Native American. And so she tried to get like special access because she's from a minority protected group or whatever, Native American. It turns out she's not, and it was all a big lie. So he'd call her Pocahontas. But anyway, she's on the warpath on an anti-crypto campaign. She reintroduced, because nobody won it the first time, so let's try it again, reintroduced the Digital Asset Anti-Money Laundering Act. And basically, it's a whole bunch of laws to crack down on money laundering and terrorism because, of course, that's real bad. Never mind that fiat, about $2 trillion of fiat was used for that. Never mind that. Never mind that the Obama administration sent like hundreds of millions of dollars in cash over to Iran. Never mind any of that. But it's the digital assets that we have to worry about. And basically what this bill is trying to do is force KYC, know your customer rules, onto people using, people in the cryptocurrency space, such as like wallet providers and crypto miners. So if you're mining Bitcoin or crypto, then you're supposed to know your customer. But how is that possible? It's not possible. If you have your own wallet, you're custodying it yourself, and I transfer to you, then I'm supposed to capture all your information somehow. That's what these things are. Now, what I think is that it shows just technology is advancing faster than the governments can keep up with it. And when they try to put bills in regulating technology like this, it shows how incompetent and how irrelevant the government is. The current form of government that we have today was designed for the world that we lived in 100 years ago when we had mass manufacturing and mass management. But that world no longer exists. And so the form of government that we have today is no longer compatible with the world that we're in. And the more they try to enforce old world regulations onto the new information world, again, they look irrelevant and they look incompetent. Every single day waking up and seeing another new headline that shows the two-tiered system that we have for criminals, for prosecuting criminals. If it hasn't become apparent to you yet, then I guess there's no hope for you. But we can see that the judicial system, this is a tongue twister. The judicial system has been weaponized against political opponents, and the two-tier system is more apparent than ever. And you don't have to look far to see this everywhere. One of the things that really finally sent the cryptocurrency markets into its final tailspin, which then brought the ire of every regulator in the world to come and go full scale against it, was the collapse of FTX. FTX was, of course, founded by Sam Bankman-Fried, SBF. I've covered this extensively. Go back in the archives on the podcast. Just search the Mark Moss Show on your favorite podcast player to go back and understand who SBF was and FTX, etc. I did some sort of investigative journalism on my main YouTube channel, Mark Moss, where I really went deep into who he was and his family, etc., if you want to understand that. But one of the things that he did, very, very fishy, was that FTX opened right when the Biden administration announced he was going to run for president. Now, maybe that was just coincidental. Probably was. But Sam Bankman-Fried and FTX stole tens of billions of dollars and became the largest donor for the Democratic Party. He was the second largest donor for the Biden administration. So they got involved with money from Ukraine. I mean, there's a lot of dirty ties. Again, go back to my main YouTube channel, search Mark Moss SBF if you want to find out about all that, all the details. But one of the things that they did, as I said, is started up this right at the time when Biden was running and started just funneling tens and tens and tens of millions of dollars, I think up to $90 million to the Democrat Party. Now, this is a big deal for a lot of reasons, one of which it violates all kinds of campaign finance laws that we have. Two, when you do this right before a bankruptcy happens, the bankruptcy court will usually go and claw back those funds. Oh, you made a transfer right before you've been bankrupt. We're going to go back and take that back from the person. That's the way it works. Well, he had all kinds of charges against him for campaign violence, as he should. There should be lots of them. But mysteriously this week, we saw federal prosecutors have now decided to drop the campaign finance violation charges against him. They came up with some stupid story about, the Bahamas court, extradition, something like that, as if the U.S. is beholden to the Bahamas. I don't think that's the way it works. As a matter of fact, I believe almost every nation on earth has an extradition treaty with the United States. It's not the way it works. On top of that, we had a federal judge, Judge Lewis Kaplan, placed a gag order on SBF, so he won't be talking about it. But all of these charges were dropped. Now, he was charged with using straw donors that allowed him to evade contribution limits on individual donations to candidates. All right, he donated the money. We know this. All right, but he somehow didn't have to face any problems. Now, let me talk about why this is a two-tiered system. Let me give you an example. So maybe some of you guys have heard of Dinesh DSouza. Now, Dinesh DSouza is a filmmaker. He makes a bunch of documentaries and things like that. He did one, I forget the name, 2,000 Mules or something like that, where he kind of showed like all the election fraud that was happening. But he did one, I think he did two on Obama. And he basically did this documentary on Obama where he went and showed who his dad was in Kenya and who his mom was and growing up in Hawaii and how he was sent at a young age to go live in Chicago and who he lived with in Chicago, who ran the Red Star, which was a communist newspaper, and his rise. Shows the whole thing. If you want to know who Obama is, go watch this documentary by Dinesh D'Souza. Well, it doesn't turn out that Obama and his handlers liked that. They didn't want to be exposed like that. That Obama, I'm not going to go into all the conspiracies. You can go watch that yourself. But it turns out that the establishment that put Obama in power didn't like that too much. And so Dinesh D'Souza became enemy number one. And so they went after him and they put him in prison. What did they put him in prison for? Campaign finance violations. Oh, like Sam Bankman-Fried just got let off of. So let's see. So Sam Bankman-Fried gave like $90 million and got let off. But Dinesh D'Souza, oh no, he attempted to illegally contribute over $10,000 to a Senate campaign, willfully undermining the integrity of the campaign finance process, is what it says here. This was September 23rd, 2014. I'm reading the charge here. So he was sentenced in a Manhattan federal court to 5 years of probation for campaign finance fraud for attempting to illegally contribute over $10,000. What he did is he gave $10,000, $5,000 for himself, $5,000 for his wife, and then some people that worked for him also contributed, and then he reimbursed them. We're talking a total of $20,000, a total. But because he didn't document it properly and because he reimbursed them, that's what they called straw donors. And because he used these straw donors for a total gross sum of $10,000 or $20,000 collectively, then he got sentenced to 5 years. But Sam Bankman-Fried was also charged with straw donors, but this time $90 million. And of course to Democrat candidates and not Republican. And he just got his charges dropped. Anyway, enough time on that. You understand what's going on. Big deal there. Some other big deals that we saw going back to sort of the combination of politics, finance, and technology is more Elizabeth Warren, more Pocahontas. Elizabeth Warren and Graham put a new bill together to now rein in big tech because they hate technology as much as they hate they hate progress. They hate new technology. And basically what they want to do is they want to create a new government regulator that would be in charge, a new government czar to control business. Sounds great. Sounds like fascism. To rein in Meta, Facebook, Apple, Google, Amazon, etc., and all these big tech platforms. And they want to create a commission that would create laws that would tighten the antitrust, that would forbid companies from preferring their own products over their rivals. I mean, that sounds okay, and I guess that's pretty good. I used to sell a bunch of products on Amazon. I sold thousands of products on Amazon, and I know the way it works. Like Amazon sees what are the big sellers, and then they create their own copy products of those Amazon brands, and they sell them, and they sell them over other products, sort of like Costco does. Costco has like Kirkland brand, right, and they sell their own products. These are like sticky issues a little bit, right, where I believe in free markets, and so if I create a giant store, whether it's Costco or a grocery store or an online store, I should be able to sell my own products, and I should be able to determine which of those products get preferred treatment. I mean, I don't understand what the big deal is. Now, unfortunately, it gets murky because then big corporations, like all these big ones I named, then start to use the government. They lobby the government to pass laws and regulations that then allow them to build themselves a moat that prevents other people from coming up and competing against them. And so in order for free markets to work, you have to allow for the competition to be there. So it's not free markets, it's not capitalism, it's what we'd call corporatism. And so I'm against corporatism. The problem that I have with this is more of the same problem. So by creating this regulatory body, then they can then take control and regulate how these businesses work. So that's more corporatism, governments and corporations working together. And through lots and lots of money spent through lobbying, these corporations take over this regulatory body and then control the whole thing, which is a bigger moat and prevents even more competition from coming up and challenging them. On some other big news that also maybe fits into this thesis as well, but it really kind of goes back into this bigger ESG narrative that we talked about earlier, and how they're creating these energy crises. What they're doing through ESG is centralizing control of the energy. And of course, we've known this for a long time was the attack vector. Henry Kissinger framed this up many decades ago when he said that if you control the food, you control the people, control the energy, you control a continent, control the money, you control the world. So they want to take over the food, energy, and money. And then by taking those over, then they can control mass amounts of people. That's centralized control. And so these ESG mandates sort of do that by saying you can no longer get decentralized access, democratized access to energy. You can't dig up coal or natural gas or oil out of the ground anymore because anybody could just go do that anywhere in the world, and we can't control that. So you can no longer use those forms of energy. Instead, you can only use the forms of energy that we say that are made in our factories, like wind and solar. And it's caused massive problems. We covered that extensively. We talked about what's happening in Germany, what's happening in South Africa. But some big news that I saw this week in the United States shows that things might be turning around. So again, breaking centralization to decentralization. And that is the first U.S. nuclear reactor built from scratch, entered operation in Georgia. Finally, they've been working on this for a long time. It was overdue. It was supposed to have been completed in 2016. It went way over time. It went way over budget, but it's a big deal. It's the first nuclear reactor that has come online, I want to say in like a decade or a couple decades. I thought I had it here in my notes, but I don't see it. But this is a really big deal because it shows a shift. For a long time, they've been trying to push towards wind and solar. When I say they, those that control the ESG narrative, and that's really the UN and the investment banks. If you want to know, again, go back and watch that episode where I just broke all that down. But this is a big deal because it starts to sort of democratize this power access. A nuclear reactor can now power like an entire town or entire city. In fact, in this case, Unit 3 of Plant Vogtle was completed. Again, 7 years late, but its full output is 1,100 megawatts, which can power 500,000 homes and businesses. That's a big deal. The views of nuclear power has been bad, were because it's dangerous and it's whatever, mostly because it's dangerous, but it's also carbon free. Now, I think that's the wrong metric. I think trying to measure the world by carbon output is actually ridiculous. I could do a whole episode on that if you want. Let me know. I'll do that. But if you want carbon-free energy, well, then this is the way to do that, right? Now, we know that there are many, many more planned to come online, so this is the start of a big trend. And what's important to understand about this is, again, understand the directionality of where we're going. If they want to continue to push energy in the United States to be carbon-free, this is the way to do it. Not like what Germany did. Germany shut down their working nuclear reactors and then invested into wind and solar. And then they had a low wind year. And then the windmills didn't blow. And so this is the way to do it. I think you should replace the energy first before you shut down other sources. Now, just for some numbers so you can understand where this is at, France derives about 70% of its electricity from nuclear energy. Now, France has cheap energy and lots of it. Germany has very expensive energy and not enough. The differences are that France has 70% of their energy coming from nuclear, and Germany shut all theirs down. So I think this is a big trend. I'm excited for it. Of course, we know other nations in the world, like China, are building nuclear reactors as fast as they possibly can because they understand this. Somehow, just in this developed world, we don't quite understand that. Now, for some other numbers, we know that in the United States, about 20% of the electricity in the United States comes from nuclear sources. So 2 out of 10 people in the U.S. get their energy from nuclear. We also know that the U.S. buys about 30% of the world's uranium for nuclear. Where do they get that from? Turns out they get it from Russia and Kazakhstan. Turns out we're supposed to be sanctioning Russia and we're not supposed to be buying our energy from Russia. So that's pretty interesting. So sanction everything from Russia that we don't need, except for, oh, shoot, we really need uranium. So let's go ahead and keep buying that. Now, why are we in that situation? Well, growing up as a kid, we were in a Cold War with Russia. We had superpowers, 3 superpowers with nuclear weapons. And we got to a point with Ronald Reagan where it was like mutually assured destruction, where we all have nuclear weapons, we can all kill each other, so let's just not. Sounds like a pretty good idea. Well, then the USSR collapsed, and the United States basically went to Russia and said, hey, we'd like for you to start denuclearizing. You have way too many nuclear weapons, denuclearize, and what we'll do is we'll buy all that from you for our nuclear reactors. And so we did. And so the United States started subsidizing, started buying all of that. And what happened because of that is that then all the investment capital, entrepreneurs and investment capital in U.S. uranium dried up and went away. As a matter of fact, today, there is like almost no uranium in the United States. I think 270 people in the U.S. work in the uranium industry, which is pretty insane considering the U.S. buys 30% of the world's supply and 20% of people in the U.S. depend on it every day. But we have 270 people in the United States. It's insane. And the bigger problem is that we're completely dependent on Russia and Kazakhstan for it, and at the same time, we're sanctioning them. If they decided not to sell it to the United States anymore, that'd be pretty bad. 2 out of 10 people would find themselves without energy. But this is the turn. We are now starting to develop uranium supplies in the United States. We're seeing nuclear reactors coming on. It's a big deal. Some other big deals that I saw this week that I thought were pretty important was more bank closures. We talked about this the other day, I think last week, talking about one of my good friends, Dr. Joe Mercola, had his bank account shut down. Just like that. And it was like one of those movies where like, hey, we don't just kill you, we're going to kill you and everyone you love and everyone they love. And so they didn't just shut down his bank accounts. They shut down the bank accounts of other people that work for him and their family members. And it just illustrates the importance of having money that can't be shut off. You see, the banking system that we know today requires permission to join, which is why Russia got their permission revoked, right? That's what the sanctions were, kicked them out of the financial system. And if it can happen to Russia, it can happen to anybody, like Joe Mercola, like it did to lots of other people. And we saw the same thing happening this week, more of that, where I saw Patreon, which is a popular service that creators use to get money. They got their payment access blocked. We also saw this week the cannabis industry has major headwinds, including, not really being able to join the banking system. Even though it's legal in many of the United States, they're not allowed to use banking. And the second largest payment processor, MasterCard, basically told all the shops that they can no longer allow U.S. customers to buy legal marijuana in shops using its debit cards. It's a pretty big deal. Now, again, it highlights the fact of why this old system is dying. You have a centralized system that's set up on rules that require permission. And if you don't do what they say or what they like, then you no longer have permission, even if you're doing something legally protected. They're selling legal marijuana, but yet MasterCard says you can no longer use our network. So what do? Turns out you need like a permissionless system, a censorship-resistant system. And of course, that's Bitcoin. That's where technology comes in to play. Now, one of the best ways to protect yourself from the financial system that can be weaponized against you from thousands of years has always been gold. In 1933, the government seized all the gold. But if you didn't have your gold in the bank, they couldn't have taken it from you. Just like we say without Bitcoin, no keys, no coins. Same with gold. Now, I like to hold some gold just in case, and I get asked all the time where I get my gold. I work with a company called Universal Coin and Bullion. I trust them because I've worked directly with the president, Mike Fulgens. He wrote the consumer alert on gold coins for the Texas Attorney General, and they have great prices. I love great prices too. And he's got a very special offer for my listeners. You can get a 1 ounce gold American Eagle coin, which is the most popular gold bullion coin in the world. And he's going to give it to you at his dealer cost. And he's even going to pay free shipping for you. All right. Now, he's also going to send you his 30-page national award-winning gold guide, absolutely free if you mention me, Mark Moss. Give him a call, 1-800-UCB-GOLD. Again, 1-800-UCB-GOLD. You can go online to universalcoin.com/Mark Moss. Just make sure if you call him, mention Mark Moss, you can get that deal on the 1 ounce gold coin and the national award-winning gold guide. If you're just tuning in, you've been listening to The Mark Moss Show, breaking down the latest news headlines in this week, looking at the world of politics, finance, and technology. And that's what we got. Thanks so much for listening. Until next time.